Well, joining us now is Lule Demmissie, eToro U.S. CEO. Lule, it's always great to have you on the show, and that's exactly where I'm going to start with you. And we talk so much about traditional 60-40 breakdown of portfolios. You have a lot of data at your fingertips in terms of the retail investors that are trading on your platform. What are you seeing in terms of that breakdown on average between stocks and bonds and crypto and cash, especially since eToro, like so many of these new fintech names and trading platforms, pays out a high interest rate on that?
Yeah. First of all, pleasure to be with you. Happy holidays. Yeah, it's interesting, because of the customer base we have, which really tells you sort of the chronicle of sort of tomorrow's investors as well, because it's millennials or younger. What you see is really sort of the narrative of 60-40 is pretty much dead. That doesn't mean diversification is dead, right? So the way you see is that lots of people are holding cash because they're not stupid and interest rates are high still, so they're getting yield from that. But then you see them participating in single name stocks. About 80% of them say they're holding single name stocks, and they actively trim when the market gets rich and buy when the market gets a little affordable or less stretched, if you will. But you also see this expansion. We thought after COVID, risky assets would be sort of reduced, especially in a high interest rate environment, but that hasn't been the case. About 10% of them say they own options or other types of like high risk instruments, including our top 5 sort of ETF holdings are in and outs in ETFs that give them that ability to have leverage as well. So it's a mixed bag, but it's not one where it's only chasing the red hot dot.
It is interesting to hear that too, and you got to wonder, and I don't know if the verdict is still out on this, but you have to wonder if more folks, especially young folks, because they were sitting at home, they did start taking on day trading. They have had access to newer platforms such as eToro, whether they have just become more sophisticated as retail investors, as traders, versus maybe some of their older counterparts.
Indeed, not only more sophisticated, I would say they're not necessarily like, the kind of skills that an asset manager might have, right? Mm-hmm. But definitely more nuanced in their understanding in the markets. They can have like 3 thoughts in their minds, right? Which is what an investor needs to be able to have. The other thing they have, which is really interesting over, I feel like some of their older counterparts, is resiliency in investing. Like you didn't see them running away this time around, right? Like household investing didn't dip in the retail space this time around when we saw the bubble burst. So it's not just expertise that rose because of practice and knowledge and communities like eToro's platforms, but it's also resiliency that increased.
Okay, so since this most recent pullback in the market at the end of October, to that point, what have folks been buying and selling? And at a time where, to use Bespoke's word today, everything is overbought, is it more selling or more buying right now?
So they do in different things. So when the rally first started, what you saw is our put call ratios really sort of shot up. So a lot of more calls than puts. So you saw people sort of express their thesis and options early on. And then as they saw a little bit more comfort in that rally, you saw names that they thought were a little bit more left behind in the tech. Now, tech is rich as in general, but you have to remember our investors are very tech heavy in the first place. But you saw Tesla participation increase a little bit more. You saw Google participation increase a little bit more. So where they felt that there was a slightly more relative value earlier on, before all of these stocks became a little bit more richer, you saw. But then what you saw is when we saw a little bit more rallying, you saw people trimming in similar names as well.
Crypto, despite some of the regulatory overhangs, despite some of the controversies, in a year where Sam Bankman-Fried, for example, was convicted, we've seen Bitcoin rally more than 160% since the start of the year. And it's been a similar move for Ether and some of these other cryptocurrencies, too. What are you seeing in terms of crypto appetite on the platform?
Yeah, it's fascinating, right? Because you would think all this stuff that we went through would have sort of like killed the asset class, and quite the opposite has happened. So what we do see is a lot more holding and then opportunistic buying. So 60+% of them still hold crypto of one sort or another. The top holdings are things like Bitcoin and ETH and Shiba. But when we sort of research the why, it's about the same things that a sophisticated investor would talk about, right? Eventual scarcity of a coin like Bitcoin, the halving that's coming around, the fact that, they may end up being spot ETFs, and the fact that there's a TradFi sort of path towards Bitcoin. So all these things are sort of adding up to people thinking that there's still a force multiplier in these selective coins.